Hey guys and girls, this is CA Anita Gandhi and I welcome you back to my video on principles of investing. If we recall last time we spoke about what are the 6 principles of investing, and the idea of this show is purely on the educational purposes. One of the important criteria which we discussed in the last series was the quality of management of the company in which you intend to invest, and this is one of the very prime criteria for investing. There are no defined formulas how to judge the quality of management. So when it comes to quality of management, the first is the people who are behind this business, the owners or the major promoter holders who are running this business. Who the board management, are they qualified to run that business, and there are no legal complaints, there are no compliance issues with the management. Whenever in India we come out, companies come out with IPOs, the background of the directors is also given, and at the same time there is one part in which they need to write if there are any legal complaints, or if there are any criminal cases or any other kind of cases on that particular directors. So from there you can find out how is the quality of the management. And today when we read about, say, maybe Infosys, immediately what comes in our mind is Narayan Murthy ji, and we know their lifestyle, we know their intent and how much time they have given for running their businesses. So these are not very difficult things to find out, and the management with the right intent, right resources, right focus in the business, they will keep on succeeding in the business. Even in tough times, they may find it difficult to run business. However, they will sail it out those tough times because of their aim, because of their ability, and because of their commitment towards that business. So that commitment towards the business is very important. And that's the first thing that every investor need to look at as far as investing in any company is concerned. The second thing is, one is the top layer of the management. The second is the senior employees of the companies. We also call as, there's something called as a key management personnel, which is available in the balance sheet of the company. Now, whether the company is able to retain its senior employees, what is the duration of these employees with the organizations? Are there people who are committed, the top level management people, key management people, are they working with the organization for longer duration of time? Or there is a very fast churn out of employees, and if that fast churn out of employees is there, then why is it so? Is there any logical reason behind it, or there's something which is happening behind which you're not aware? So that needs to be figured out. The third one is the lower level of employees, and even they need to be little steady with the jobs. At that level, some amount of churning keeps on happening if there's a very high demand. For employees, what we see recently, IT sector has gone through that, what we call it, that word is called as attrition. IT sector recently had very high attrition, and the impact of that we have seen in the business, that to retain good amount of employees, the companies had to shell out more amount of money. They have to give more increments, more promotions. There are companies who have given salary hikes 3 times in a year, and all this is going to impact the cost, the salary cost, the salary bill for the employees. And obviously in a IT sector like IT, which is driven more by human resources and intellectual capital, if the employee cost keeps on rising, obviously is going to have impact on the margins of the companies. What we need to see is the top level management, the middle level management, that is the senior level people, and at the same time the lower level people, if there is very high attrition. What is the compensation scale of the organization? If it substantially differs with the companies in the similar sector, then you need to have go a little more in depth and find out, is this company rewarding lesser remuneration? Is this company rewarding too much higher remuneration? Is the major part of the remuneration goes to the family people? If it is a family oriented business, then you need to whether the company is following more professional practices. These are some of the criteria which you need to see. The another important factor what you must have a look at is what is the policy of the company to reward its shareholders. There are a good amount of big companies where they have a dividend policy, and that dividend policy is clearly mentioned in the balance sheet of a company. There are companies which are pretty cash rich, and some amount of cash flow is every year used to reward the shareholders by way of dividend that has already been defined and which comes as a policy statement, and the shareholders are rewarded year on year with the good amount of dividend. The other way of rewarding shareholders is buyback, bonuses. Are the companies doing buyback to deploy cash? So in IT companies particularly, what happens is they are not highly capex driven companies. There's good amount of cash flow generation every year, and these companies try to reward the shareholders more with dividend at the same time buyback. Companies like Infosys, many years back, they mentioned that 75% of their free cash flow will be used for rewarding shareholders. So these are the companies which are very much liked by the investors, and they keep on doing well. Another thing is there is something called as a dividend yield also. So this yield is based on what is the price of the company and how much dividend a company has given, and you work out the yield. So those companies which offer very high dividend yield and which is even higher as compared to the normal rate of interest, even those companies are also good to invest for those who are conservative investors, which will take care of some amount of their investing cash flows. They will keep on receiving good amount of dividends every year. So primarily the company needs to have good amount of intent to take care of shareholders and ensure that shareholder comes first as far as the rewards, the profits of the companies are concerned. They need to be rewarded with good amount of either dividend, buyback or bonuses. And these companies who are able to do it year on year, they are good companies to do investments. And every year the companies generate good amount of cash flows, and how these cash flows are used, what is the company's policy with respect to its investment surplus, and what is the acquisition. So that means if company is doing any acquisitions which are either for forward integration or backward integration, it's well and good. However, if company keeps on acquiring businesses which are not of their core business intent, and they keep on acquiring some businesses which are of the different nature, then obviously that's not a very good sign, and one needs to look at it why this company has used this cash to acquire a particular business which is not the core activity of this company. So allocation of capital is very, very important, and again one can see it from the usage of cash flows. That's how one can study that particular factor. And the most significant is the criteria for assessing the quality of management is the company ROE focus. If at all there is any debt in the balance sheet and the company is paying interest on it, and that interest amount is higher than the return on investment on the equity, then I don't think they are on the right track as far as borrowing money. There are formulas to assess that. Through those formulas, if those companies who are committed to generate good amount of return on investment, they are good companies, and these are some of the criteria when assessing for the quality of the management. In my next show, I will talk about the other principles of investing. What I want to just insist here is follow the process thoroughly. And when we see so many success stories of people, be it in acting, be it in investing or any walk of life, they are all successful because they follow right processes. Rome was not built in a night, and it took so many years. So the work which goes behind what you want to be successful in is more important than just looking at the results. So start looking at things, and I will again meet you in my next show, and will share with you the another principles of investing. Stay tuned.